So 3 years ago, I got my first credit card, and within the first month, I accidentally lowered my credit score because I didn't actually understand how the credit system worked. And at the time, I thought I was doing everything correctly. I didn't have any missing payments or any debt that I had to pay off. And now we fast forward to today. I'm 21 years old and my credit score is sitting at a roughly 770, 775-ish. And the crazy part is I didn't build that score by doing anything complicated. I just learned how the system actually worked and started following a few simple habits. So in this video, I'm going to try to explain the mistake that lowered my credit score when I first started, how credit scores actually are calculated, and the habits that helped me build a 775 credit score in less than 3 years. Because if you learn from the mistakes that I made and understand how the credit system works early, you can avoid the mistakes that most beginners make. Growing up, both my parents never really understood how credit worked. To them, credit always felt like this complicated system where one small mistake could ruin your financial future. And because of that, they didn't really use credit cards that much. They mainly just use debit cards or cash. They saw credit as something more risky instead of something that can be useful. And honestly, I can completely understand why. Many people were never taught how credit actually works. And in high school, they don't even teach you how to build your credit. So it's really up to you to teach yourself. A lot of people just learn through trial and error. And this learning curve of credit scores, interest rates, and credit utilization all sounded confusing to me. And at the time, it just seemed like one of those adult things that I would figure out later in life. But once I got closer to my senior year of graduating high school, I started to hear a lot more people talk about credit cards. Some of my friends were applying for them. Some of them were talking about building credit before college. And I kept hearing that your credit score can affect things like getting approved for apartments, financing a car, or even getting a mortgage later in life. So the smart thing to do right out of high school is to build your credit early. And that's what I did. Right before my first semester of college started, I decided to apply for a student credit card. I ended up applying for a Discover Cashback card since it was catered towards college students. And student credit cards are specifically designed for people who are new to credit. That means they're usually easier to get approved for, and they often come with beginner-friendly benefits. I remember when I got approved for it, and I was pretty excited. It felt like one of those moments where you start stepping into adulthood. But the truth is, even though I had a credit card, I still didn't fully understand how the system worked, and that led to the first mistake I made. And not long after I got my credit card, I needed to buy a laptop for school. Since I started college, I needed a computer for my assignments, studying, and basically everything related to school. So my mom went with me to buy one at Best Buy. And on the way there, she suggested something that sounded reasonable. She told me that I should put the laptop on my credit card. Her reasoning was simple. If I used my credit card and made payments on it, it would help me start building my credit history. And honestly, that sounded like good advice. That laptop ended up costing me around $1,100. My mom suggested that I pay about $500 the first month and then slowly pay off the rest over time. And remember, at this point, I had zero experience using credit cards. I didn't understand statement balances, credit utilization, or how credit card scores are actually calculated. So instead of doing my own research in the beginning, I just followed that plan. And again, this wasn't my mom's fault at all. She was just trying to help me based on what she understood. But over the next few months, something unexpected happened, and my credit score actually started going down. And that confused me a lot, because in my mind, I was doing everything right. I wasn't missing payments, I wasn't overspending, so why was my credit score dropping? And that's because I didn't pay off the full amount of money I owed before the next month. Once I started to research how credit scores are calculated, the entire system started to make a lot more sense to me. One of the most commonly used credit scoring systems was developed by the organization FICO, and your credit score is mainly determined by 5 factors: payment history, credit card utilization, length of credit history, new credit inquiries, and credit mix. Once I understood these 5 categories, I realized exactly why my score had dropped. So I'm going to break down all 5 of these because they can be very confusing. The most important factor in your credit score is payment history. This category makes up about 35% of your total credit score. And I highly advise you not to miss a payment because that can really have some negative effects on your credit score. And what this measures is pretty simple. It tracks whether or not you pay your bills on time. So if you consistently make payments before the due date, that builds up that positive credit history. But if you end up missing payments or pay late, your credit score can drop pretty quickly. And late payments can stay on your credit report for years. So paying on time should always be your number 1 priority. One habit that helped me stay organized was something very simple: I started tracking my credit card spending throughout the week. Every time I used my credit card, I wrote the purchases down in my notes app. Then every Sunday, I would add everything up and pay it off. I wouldn't continue with my week with a remaining balance. So then this helped me stay aware of my spending and prevented me from accidentally carrying a balance. Now I'm going to move on to the next section, minimum payment versus statement balance. Another thing I had to learn was the difference between minimum payments and statement balances. When you log into your credit card account, you'll usually see three numbers. What these three numbers consist of are your minimum payment, your statement balance, and your current balance. The minimum payment is the smallest amount your credit card company requires you to pay. And usually it's only about 1 to 3% of your total balance, but paying the minimum keeps your account in good standing and prevents any late fees. But it doesn't prevent any interest from accumulating, and that's where something called APR comes in. What APR stands for is annual percentage rate. It represents the yearly cost of borrowing money. So for example, the higher your APR is, the more interest you'll pay if you carry a balance. So what your goal should be is to always pay the full statement balance every month. And if you do that, you avoid interest completely. For example, if you have a statement balance of $600 and your due date is next month, if you pay the full $600 before that due date, you pay zero interest. Alright, now we're going to talk about credit utilization, which is the next part. This is the second biggest factor in your credit score, and this category makes up about 30% of your score. Credit utilization simply measures how much of your available credit you're using. So for example, if your credit limit is $2,000 and you spend $1,800, that means you're using 90% of your credit limit. And that's considered a very high utilization. But if you only spend $100 out of that same $2,000 limit, your utilization is only about 5%, and that signals responsible credit use. Most experts recommend keeping your utilization below 30%, ideally closer to 10%. And this was actually the first mistake I made when I bought my laptop. My credit limit was around $1,500, and I used about $1,100 of it, and that meant I was using around 75% of my available credit. And even though I planned to pay it all off, the credit system only saw high balance, and high balances signal higher risk to lenders. Now moving on to the next factor is going to be your credit history length, and this is another factor that affects your credit score, and this category makes up about 15% of your score. It measures how long your credit accounts have been open. The longer your accounts stay open, the more trustworthy you appear to lenders. And so this is one of the reasons why you might want to start early, because the longer your credit history is, the more reputable you are to lenders. And even if you have one credit card that stays open for many years, it can help you build that strong credit history. But don't ever close any credit card accounts that you have. By doing that, it would reduce your total available credit, which increases your credit utilization ratio. It will also shorten your average credit history length. The next topic I want to talk about are hard inquiries. So whenever you apply for a credit card or a loan, lenders perform something that's called a hard inquiry. This is also known as a hard pull. So this occurs when a lender reviews your credit report to make a lending decision after you apply for credit. So if you have too many hard inquiries in a short period of time, this can temporarily lower your credit score. Hard inquiries usually stay on your credit report for about 2 years, but they typically only affect your credit score for around 12 months. And because of that, it's best to space out credit applications. The safest thing to do is apply once or twice every year. That's roughly around 6 months. This gives you enough time to open different lines of credit without being penalized. And the final factor we'll be talking about today is credit mix. This usually refers to different types of credit accounts you have. For example, credit cards, student loans, car loans, and mortgages. Having multiple types of credit can slightly help your score, but this category only makes up about 10% of your credit. So it's not something beginners really need to worry about too much. It's just kind of if you want to be nitpicky about it. And once I understood these factors, I started building habits that helped me grow my credit score. One of the biggest habits I follow is treating my credit card like a debit card. The benefits that credit cards offer outperform the use for debit cards. Credit cards often have better protection if fraud happens, because it's not your money that's at loss, it's the bank's money. And they'll do whatever they need to do to get that money back. And that money is always insured by the bank. But the most important rule I follow is simple. I only use my credit card if I already have the money in my bank account. And if I simply don't have the funds to buy something that I want to buy, that prevents me from accumulating debt or paying interest. And there's a few myths that I want to go over about credit. The first myth is that carrying a balance helps build credit, which is simply not true. Paying your full statement balance every month is actually the best strategy. Another myth is that checking your credit score lowers it. Checking your own credit score is often a soft inquiry, which doesn't affect your credit score. This is different from a hard inquiry, whereas that would be a lender checking your credit. There's no risk in simply checking your own credit score. It has no negative impact on you. If you don't have a credit card yet, start early so that you can make a big difference later in life. But building good credit isn't about being rich. It's about understanding how the system works and using it responsibly over time. So if you follow what I've told you, you make your payments on time, keep your utilization low, and stay consistent, your credit score can grow faster than you might expect. Looking back on that situation, one of the biggest reasons I wanted to make this video is because I want other people to learn from my mistake instead of repeating it themselves. So even though I wasn't doing anything reckless, I still made a mistake simply because I didn't understand how the credit system worked. And that's the reality for a lot of people when they start building credit. No one really teaches you these things step by step. And you usually figure it out through experience, and sometimes that experience includes making a few mistakes along the way. So if you're watching this and you're just getting your first credit card or thinking about opening your first line of credit, my goal is that you learn from these mistakes that I made early on and start building your credit the right way from the beginning. And if you follow those habits, they can set you up for better financial opportunities later in life. But that's all. Later.